SurePoint Advisors is an investment advisor in Brielle, New Jersey. SurePoint Advisors is registered with the Securities and Exchange Commission. Registration of an investment advisor does not imply any specific level of skill and does not constitute an endorsement of the firm by the Commission.
Welcome to another episode of SurePoint Advisors Financial Roll Call with James Fay. We are 10-8 in service. This is a podcast for law enforcement, by law enforcement. I am James Fay. I'm a retired law enforcement officer and now financial advisor with SurePoint Advisors. And I'm focused on helping law enforcement officers make educated financial decisions that will directly affect their retirement. I truly believe that this podcast will help accomplish that. All right. So often is the case, I get my current law enforcement clients calling me or emailing me with a question about investment properties, right? They hear somebody else on their squad or in their law enforcement agency talking about investment properties and what a great idea that is. So I thought it would be great to do an episode on the introduction to investment properties. And those of you that want to get into investment properties most likely don't have the cash on hand to just buy the property outright. So what do you have to do? You have to go to a lender and you have to apply for some sort of mortgage, right? To secure that investment property. So who better to talk to about this than Anthony Marone? For those of you that don't know Anthony, Anthony is a loan officer with New Jersey Lenders. Anthony is also a law enforcement officer here in New Jersey. He is a wealth of knowledge in and around the mortgage topic, and he had a lot of great input. I was able to sit down with Anthony and to interview him on this very topic, and he gave us a lot of great insight as to the different ins and outs that you need to know before you step in to this realm of securing investment property. So I want you to take a listen to this interview. Welcome to another episode of SurePoint Advisors Financial Roll Call with James Fay. We are 10-8 in service. This is a podcast for law enforcement, by law enforcement. All right, once again, I want to welcome back Anthony Marone to impart us with some more of that knowledge that he brings to the law enforcement community and our listeners here on the podcast. How you doing, Anthony?
Good. Thank you, sir. Thanks for having me back. Pleasure to be here.
Absolutely. Thanks so much once again for taking time out of your busy schedule. I appreciate it. So I think you're either tied or running a close second to our favorite estate planning attorney, Michelle Clark, for appearances on the podcast. So I appreciate it.
Awesome,
although we're gonna have
absolutely.
Michelle back. We're gonna have Michelle back soon to do a little episode on special needs trusts. So I think that would be important. There's some law enforcement officers out there whose kids are special needs, and I think that's it's really going to help them. So, but today we got another topic to talk about. So I get a lot of calls from my law enforcement clients about the idea of purchasing investment property, and I know this type of investment is prevalent throughout the law enforcement community. Everybody's talking about it. They want to do it. They want to get into it. And their thought process is basically that they can pick up a piece of property for cheap and they can fix it up and they can either rent it out or they can flip it and make a profit on it. So sounds great in principle, but being in the finance industry and the mortgage industry like yourself, I think we both know that it's not that simple. And if it's not done right, it can end up being disastrous. So really, I thought it'd be a good idea to educate our listeners and the law enforcement communities about getting into the world of investment properties. I think that would be a great topic to talk about today. So maybe you could tell our listeners what they need to know before buying an investment property.
Yeah, absolutely. I think that, it really depends on the property. I think that's huge. Before you start getting into investing in properties, you really want to make sure that the property's cash flow positive, the property works for you. I'm a big believer that property's going to be close by. I don't think you should be buying investment properties that are, a half hour away. Me personally, if I'm buying investment properties, I would want them within a 10, 15-minute proximity of where I live. This way, if there's any problems, I can handle and deal with it. So there's a lot of stuff to look into before you decide to buy the property. It's about, the right property, make sure that property's cash flow positive, stuff of that nature. Another thing to look at when you're doing investment properties, A lot of my clients now I'm seeing are doing a two-family and they're occupying one unit and they're renting the second unit out, which is very good because what's happening with that is, just for easy numbers, let's say their mortgage payment is $3,000 a month for both units. They're now renting out that second unit for $1,800 or $2,000 a month. That $2,000 a month is rolling over and helping them pay their full mortgage debt payment of $3,000 a month. So essentially, they're paying $1,000 a month to reside in that residence, which is great. And then down the road, sometimes they keep those properties and they'll buy now another primary residence while renting out both those units as an investment properties. That's how I see a lot of our clients get started off with buying investments.
Right.
And for a primary residence property that you're going to live in one unit, to go conventional, it's a 15% down payment.
Okay.
You go FHA with 3.5% down as a primary residence as well. Or you go conventional at 15% down. Again, depending on the client, different needs, different circumstances depending on that client.
Sure.
If we were to do strictly an investment property where we have no primary residence and they're strictly never going to reside in that unit or the units, it's 20% down for a single family,
Right.
25% down for 2 to 4 families.
Right. Okay. Yeah, that's interesting and important for them to know. Let's back up a little though and talk about, if they do make this leap into the investment property world, they need to have kind of like a broad array of skills, right? Or they need to have people on hand that can fix that leaking faucet or, whatever it might be, those roof leaks that come up, whatever it is. So I'm sure you would agree that, we see some people in law enforcement that haven't swung a hammer their whole life, Anthony. So, I think that's important too.
Sure, absolutely. And then, with the whole investment properties, this year of COVID was a tough year. A lot of states put in and the government put in that you couldn't, evict if people weren't paying the rent. So from a financial standpoint aspect, people had record highs last year with investing, and then other people I know that had rental properties had record lows with collecting rent. So there's a big, historically, I think real estate is historically probably one of a great form of investment. It's great to have a diverse portfolio. You may do some investments, you do some secure investments with financial planners. But it all kind of depends. The property has to be the right property. You want to make sure that if you're doing a 2, 3, 4 family unit, that if you're collecting half of those units and half aren't paying you, you can still pay that mortgage or have the savings where you could cover both of those units or all 4 units to pay the mortgage payment. So, I think it's very particular on the properties. It's got to be the right properties key on this. You got to make sure you're cash flow positive on those properties. And you got to, have enough finances to expect that if, God forbid, you don't collect rent for X amount of time, you can cover those expenses. There are reserve requirements depending on the amount of units. So, you actually need some reserves on top of your down payment closing costs when you buy investment properties. Nothing too outside the box with those. But it's all definitely things that you want to look into when you do buy an investment property.
Yeah. It's funny you talk about cash reserves because a lot of the people that are inquiring about, securing some of these investment properties, they're carrying a lot of personal debt. And, of course, I would tell them that it wouldn't be a good idea, but what's your thoughts on that? People that carry a lot of personal debt and now they want to get into that investment property.
Yeah, absolutely. I think that if it's not going to be your primary residence, it's going to be a strictly investment property. I don't think that they might not be ready for that investment.
Right.
Personally, I think that they should probably clear off some of their personal debt. Make sure they have enough reserves. God forbid, make sure the emergency fund set up. You don't want to start tapping into your emergency fund to buy an investment property. My personal opinion on that, because God forbid something happens now. If you have God forbid a personal emergency and then that person's not paying your rent, it's going to be a really bad situation. And a stressful situation for the client,
Right.
So it's definitely something that, I wouldn't recommend, depending on what the debt's for. If it's like something like a student loan or stuff of that nature, that's different. Credit card debt is a different story. So it all depends on what that debt is for that they currently have. But yeah, you definitely want to look at a cash flow planning aspect of it, versus your debt and make sure that it makes sense for them.
Sure.
Something else too, a lot of people don't realize is that when you have an investment property, and they want to check with their CPA, but when they have an investment property, it falls on their Schedule E on their tax returns. So any profits or losses on those Schedule E's will carry over to their 1040 tax returns. So for instance, they make, let's say easy numbers, $100,000 at their W-2 job. As a police officer, they then have their Schedule E on their tax returns for their investment property. I'll say 123 Main Street. 123 Main Street makes $5,000 a year. That $5,000 a year transfers over to their 1040 tax returns, and now they show $105,000 a year on taxes for income. If it's a loss, let's say a $5,000 loss, they have maintenance, something to pay rent or whatever it is, and they have a $5,000 loss in their Schedule E, that $5,000 loss carries over to 1040. They now pay tax on $95,000. So something important, that's how the income works on investment properties. Once again, just check with their CPAs, because I'm not obviously a CPA, but that's how it works with how the income works on investment properties with your income.
Yep. Make sure you get that disclaimer out there that you're not a CPA. So good. Yeah. Excellent.
Absolutely.
So a little bit before you talked about the down payment on the house or on the investment property, I should say, and you said if you were not living in it, it's a 20% down payment. Just speak to that a little bit more, and why it's so much more than if it was a dwelling that you were going to occupy, that might be like 3% or 4%, whatever it might be. What's the difference?
Sure. There's a lot of programs out there, first-time home buyers or just lower down payments for private residences. They're less riskier products like a primary residence, right? If something happens or there's hardships, and you have a primary residence, and you have an investment, you're probably going to pay your mortgage first on the primary. Statistically, you're more likely to foreclose on an investment property versus a primary residence.
Okay.
So it's just riskier lending. So they want you to have more skin in the game when you're buying an investment property. Also, rates are a little bit higher on investments. And again, if people get very rate conscious on investment properties, they're always going to be a little bit higher because they're riskier. But at the same time, all of your expenses for that investment is going to go on your Schedule E as a cost of owning that property, which will go against your profits. So the rate on the investments isn't as concerning versus a primary residence. But the rate's always a little bit higher on investment property versus a primary residence, just so people are aware of that.
Excellent. I was actually going to ask you that question as to the interest rates being higher on an investment property, but you nailed it. I appreciate that. So
there's actually currently we're seeing them a little bit higher than usually. The federal government, Fannie and Freddie, that operates mortgages, has a 7% rule that came out. They're saying they don't want any more than 7% of loans written to be investment properties or second homes. So we're kind of this is a new year for this, that they're really enforcing it. So we're kind of curious to see what's going to happen if people go over to 7%, where the loans go, how they execute them on the secondary market, who services them. So that we're seeing the rates probably a little bit higher now. I think they're going to lighten up over time, but as of right now, we're seeing it even a little bit higher rates on investments in secondary homes for that reason. Some inside information on what's going on in the mortgage world.
Absolutely important. So let me ask you this: what are some of the other costs that people don't really initially think about when they're buying investment properties? Like, whether it's the maintenance cost annually or things like that. What can you enlighten us with some of that information?
Yeah, absolutely. It's pretty much anything that owning a house. Obviously, some people have another. Obviously your CPA filings going to be a little higher because you have a Schedule E on that. Sometimes people, technically you need permission from the lender to move it over to an LLC. That's something else that maybe you have a real estate attorney to talk about, with the liability of having that property within an LLC. This way you personally cannot be civilly sued if someone has a slip and fall on that property or whatnot. You have to worry about your assets as well. Because if you have a property, it's indeed in your name, someone has a slip and fall, and now they can actually come off through your personal liabilities as well. So a lot of people like to put properties in LLCs. Technically, if you have a note on that property, you need that lender's permission to put it into an LLC. So that's something a lot of people don't realize. But you want to make sure you're protected on that standpoint as well. Some of the other expenses you're going to have, obviously, the normal wear and tear stuff, right? Anything that goes on in a normal house, as far as any type of electric, HVAC stuff, you're responsible for everything in that property as well, obviously. So, kind of the normal wear and tear. I think statistically, they say depending on the price of the house, you should expect to see 2 to 3% in, fees of the value of that property for repair costs. So your house is $300,000, you should expect to put $6,000 to $9,000 a year into that house to keep it, active. That's just a general broad statistic that they use. There's definitely some costs involved in upkeeping that property. Stone removal, cutting the grass. I believe that some states have it that you can't pass the snow removal onto the tenant. So different states have different guidelines to that. So in your contract you might have that, but technically you can't. So there's a lot of stuff that you have to get involved with and make sure you have a very good drafted out rental agreement with your attorney. So it's more than just getting into this and buying the property and saying, hey, we're going to list it for rent and renting it out. You got to make sure from a personal liability that you're very protected as well.
So great information. Awesome. So let me ask you this. Is there any other information for our listeners that are thinking about considering buying an investment property? Anything else we might have missed?
I think that pretty much it's pretty straightforward. Just really want to make sure it's the right property, make sure you're cash flow positive on the property, make sure it makes sense, make sure it's not going to stress you out. It's going to be a positive income stream. Overall, statistically, over the years, real estate income or real estate properties are a very good source of investment income over the years. Let's say even if you're breaking even on this property now, and you're not cash flow positive month to month, but you're breaking even, that property, when you go to sell 10 or 15 years from now, is going to accumulate so much wealth that when you sell, you're going to be profitable on that end of it. But now you also have to remember, Section 121 of the IRS does not cover your primary residence. So now you might have capital gains when you sell it unless you put it into 1031 exchange, which allows you to hold that money to buy another property. So there's a lot of stuff that you have to also look into, upon when you go to sell that property, what's the long-term gain with this property, what's the end result. So it's something that you want to look into as well when just buying a property. You don't want to just buy a property and say, here's what we're going to do. You want to, what's the time frame you're going to hold this property? Are you going to be cash flow positive now? You're going to make the money on the long end. So there's a lot of going into this, a lot of reinvestment strategization that you want to use before buying this investment property.
Excellent. Once again, a wealth of knowledge you are, my friend. The law enforcement community should be considers himself quite lucky, that's for sure, to have you as an asset to educate them. So I appreciate that. And you gave me a lot of good ideas during this episode for future episodes, which might be able to have you take over the leading guest spot here on the podcast, but we'll see. So again, I can't thank you enough, Anthony, for taking the time and coming on to another episode. So I appreciate it, and be safe.
Awesome, James. Thank you. See you next time.
You got it. All right. Again, as I told you earlier, Anthony is a wealth of knowledge in and around the mortgage community and the mortgage topic. He had a lot of great insight in that interview about investment property. So 10-11, prepared a copy. Let's go over some of the takeaways we have from this episode. All right. Remember, purchasing an investment property to earn rental income can be risky. You should know that right off the bat. It's not going to be easy. Don't put yourself in a position where you lack the cash to make payments on your debt. You should always have some sort of margin of safety. And Anthony went into having an emergency account and the importance of that. In the financial industry, we always talk about having an emergency account set up. That's one of the first things that you need to have set up before you can start investing. And we recommend that. All right. So he also talked about the down payment and how generally it's higher on an investment property than just the regular owner-occupied properties that you might have, right? The house you live in, right? So that's important. You will need at least 20% down payment. And why is that? That's because there's no PMI with investment. It's not available to rental properties or investment properties. So you're going to need 20% of a down payment. Unlike maybe the 3% you might put down on your own home that you own because you live in it, right? So that's important. 20% down payment as opposed to 3%. That's a big difference, Other costs that you should include, and pay attention to this part, and Anthony did a great job explaining this in the interview, but there are other costs included with investment properties, and here are just some of them, right? How about homeowners insurance? Maybe there's a homeowners association fee that you have to pay. Property taxes, monthly expenses such as pest control or landscaping, and the regular wear and tear, the maintenance expenses for repairs. All that should be included, right, in the cost, in the evaluation of whether you should get into investment properties. And you should plan to set aside about 20 to 30% of your rental income for these type of costs, right? Very, very important. Anthony did a great job breaking this all down. He made it simple for us to understand. Again, he's a wealth of knowledge in and around this topic, and he's a huge asset to the law enforcement community. And I really can't thank Anthony enough for taking the time once again out of his busy schedule to come on another episode of the podcast. So if you need to get in touch with Anthony, you can contact him directly at Anthony Marone, NewJerseyLenders.com, Team Marone, right? You can contact me here in the office, 732-876-3777. I'll be more than happy to put you in touch with Anthony. Shoot me an email. You can find my email on our website, SurePointAdvisors.com, or in the show notes. And again, Anthony, a wealth of knowledge, a great interview. Those of you that are looking to take that leap into investment properties, it's not as simple as you think. You should really weigh out the options and all the different things that go into owning an investment property. All right? With that, this has been another episode of SurePoint Advisors Financial Roll Call with James Fay. We are 10-7 at a service.